Well, welcome everyone. My name is Richard Cullen and I'm the convener of the Taxation Law Research Program in the Asian Institute of International Financial Law here at Hong Kong U, based in the Faculty of Law. And we're delighted today to have a very well-known academic and an old friend of Hong Kong U, Professor Adrian Sawyer, to give us a presentation entitled Hong Kong and BEPS 2.0. BEPS, of course, stands for the OECD project to combat base erosion and profit sharing within and around taxation systems. Adrian is a professor of taxation in the UC Business School at the University of Canterbury in New Zealand. He has an SJD from University of Virginia and a number of other degrees from New Zealand, and he holds other important professional qualifications. He's also a prolific writer on a number of topics and published extensively internationally on taxation law. And he's chair of the editors of the New Zealand Journal of Taxation Law and Policy. I think, Adrian, rather than take up any more time, people can see your particulars on the flyer we've sent around as well. Let me invite you now to start the presentation. And as we've discussed earlier, we'll have ample time for question and answer later after you've finished the presentation. So, Adrian, over to you. The floor is yours on Zoom.
Thank you, Richard. Thank you very much. Welcome, everybody. I will just start to share my screen with my PowerPoints. If you bear with me a couple of moments. So hopefully you can now see my opening slide, which, as Richard mentioned, the topic I'm looking at is Hong Kong and BEPS 2.0. So what I'm going to do today, and I'm intending to leave plenty of time for questions, etc. at the end, is to have a little bit of an introduction, firstly to sort of a bit of my background as well as to the background that we're looking at in terms of BEPS. I will then go through and look at particularly what has been termed BEPS 1.0, which was the first and probably the largest part of BEPS, and then that which is more recent, which is the BEPS 2.0. I will then sort of take a little bit of a journey through how Hong Kong has approached BEPS to date, then reflect upon what might be the implications of the new BEPS 2.0 for Hong Kong, and then have a chance for those of you who are here online to ask any questions or comments. So, as Richard mentioned, I've had a long-standing interest in Hong Kong's taxation system. I've been very fortunate, and I'm very thankful for the support that I've had to be able to visit HKU and to be able to give a number of presentations, a number of those which I've then developed into publications. So in terms of the areas where I've got an interest in Hong Kong in the past, is I really sort of started my interest when I was looking at double tax agreements, particularly when Hong Kong and New Zealand signed their first DTA. So it was a very good way to start to look at how the two jurisdictions approached their issues over double tax. I've also had an interest in tax policy, and here I've been able to share experiences that New Zealand had, first of all with GST, when the most recent occasion when Hong Kong was debating whether it should have a GST. Then I also talked about how New Zealand develops tax policy and whether this could be a useful approach for Hong Kong, and then comparing New Zealand and Australia, and then how they might have things that could be considered in a Hong Kong perspective. I've also looked at an area which sort of started with BEPS that followed on, which is in the area of exchange of information, where I've looked at how Hong Kong has responded to pressure that it was receiving to be involved in information exchange, a number of publications there, and more recently, starting to look at BEPS 1.0 and 2.0. So there was initially a paper looking at as Hong Kong started to initially engage with BEPS, and then on my very last time I was able to visit HKU back in November 2019, where with Judith Freeman, we did a virtual seminar starting to look at what was happening as the emergence of BEPS 2.0. So I sort of wanted to lay that out to let people know that I've got a close interest, and I intend to maintain that interest, even if for the time being I need to stay offshore back in New Zealand, but still have a keen interest in what's happening in Hong Kong with respect to international tax. Excuse me. So I'm going to go through and have a look at BEPS 1.0 and 2.0 and look at how Hong Kong's been engaging, first of all, generally with the work of the G20 and the OECD, but I will spend most of my time on BEPS 2.0 because that's the much more live issue that we have at the moment in terms of how the OECD has made proposals for dealing with the digital economy. But just a bit of a note, or some might say a health warning, that BEPS 2.0 is only at this point at the high-level agreement phase. So any observations or comments that I make are tentative and could change as more detail emerges over the coming months. Okay, so what is BEPS in terms of what it's about? Well, the OECD very recently in a publication earlier this year said that BEPS refers to tax planning strategies that exploit gaps and mismatches in tax rules to artificially shift profits to low or no tax locations where there's little or no economic activity, or to erode tax bases through deductible payments such as interest or royalties. They do note that some of the schemes are illegal, but most are not. So we're not talking about what might traditionally be considered to be tax evasion. We might be talking about tax avoidance or simply tax planning that is managing to exploit gaps in the international tax system between jurisdictions. So these activities undermine the fairness and integrity of tax systems because those that can operate across borders using BEPS gain a competitive advantage over those only operating at a domestic level. And the other issue is when the ordinary taxpayers see multinational corporations legally avoiding income tax, it can undermine their voluntary compliance. And of course, voluntary compliance is a crucial issue for just about every jurisdiction. So the OECD, from the early instruction of the G20 countries, took the initiatives underway and set up an inclusive framework on BEPS. Now, why this is very important is because you may be aware the OECD has got just under 40 members. It's usually been perceived as being the developed countries or the wealthier countries, and representing a relatively small proportion of the total population of the world, let alone the total number of countries. So the inclusive framework has been much broader and has about 140 countries and jurisdictions working together. So it's a very much large globalized group. So the original BEPS package had 15 actions that were designed to equip governments with the domestic and international instruments needed to tackle this global or cross-border tax avoidance. So there's tools to ensure that profits are taxed where economic activities generate those profits are performed and where the value is created, So this is designed also to give businesses greater certainty to reduce disputes, because obviously it's one thing to have a dispute within your jurisdiction. It's a much more challenging for a business to have disputes that apply cross jurisdictions. So BEPS 1.0, as it's now been labelled, is primarily focused with dealing with the shortcomings of rules that were really developed in the 1920s, that is, rules that are well known to us, like source, residence, permanent establishment, etc. Basically, a lot of the key concepts that we see in the OECD's model tax convention. So in a way, it's recognizing that the world has changed and moved on a lot from where it was in the 1920s. So another way to have a look at it is presented in these diagrams. So what really led to having the OECD looking at BEPS issues is where they were aware that there are gaps and mismatches in the current international tax rules, and obviously multinationals particularly were exploiting those. Profits were, for tax purposes at least, disappearing or going to areas where there was no tax being applied. We were seeing profits go to no or low tax locations, so collectively the multinational as a group is paying less tax, and together these are known as the base erosion and profit shifting, or BEPS. And then the other 15 boxes there are the 15 actions. So I'll just move on to the next slide to briefly talk about them. The first action, which you might find is a little ironic, which is addressing the challenges of the digital economy, actually was not really dealt with at all in BEPS 1.0. It is what is the subject of BEPS 2.0. The second action was designed to deal with these hybrid mismatch arrangements between jurisdictions to neutralize them. The third one was to deal with the controlled foreign company rules that many countries had to try and make them to be more effective. The fourth one was to limit the base erosion occurring through interest deductions and other financial payments. Number 5, which actually deals with a topic that the OECD was looking at well before BEPS started, that is identifying harmful tax practices that jurisdictions might have and coming up with ways to counter those, focusing on the two key principles here of transparency and substance. The action number 6 was designed to prevent treaty abuse, or treaty shopping as it is known, where multinationals might look to jurisdictions where they have a favourable tax treaty in place. The next one was to prevent artificial avoidance of this permanent establishment concept. Again, it was becoming increasingly easy for multinationals to get around this. The next 3, actions 8, 9 and 10, largely deal with issues regarding transfer pricing, relating to where value is created with things like intangibles, to deal with risks and capital and other high-risk transactions. Number 11 is a little bit different than some of the others because it's not so much about dealing with what's happening in jurisdictions, but creating a way for the OECD to collect and analyse data on BEPS actions, and then from that, develop or modify actions to address it. So it's more like the data collection process. Number 12 was to require taxpayers to disclose their aggressive tax planning arrangements, so therefore revenue authorities are actually aware in advance or concurrently what they are looking to do. Number 13 relates a little bit back to 8, 9 and 10, which is to re-examine transfer pricing documentation, and there were new OECD guidelines developed, which all of the member countries plus the Global Forum members were encouraged to adapt and adopt in their countries. Number 14 was to make the dispute resolution mechanisms more effective. So rather than traditionally just using the mutual agreement procedure, other approaches such as arbitration would be encouraged. And number 15, which of the BEPS 1.0 I thought personally is the most significant and I guess potentially at that point in time impactful development, was to develop this multilateral instrument to enable those countries that are interested to be able to implement the measures to be able to, that is, amend in a more simplified and streamlined way their bilateral tax treaties between their various treaty partners. So rather than have, if you had 40 treaties, to have 40 separate series of negotiations through taking this multilateral instrument, it might be much more straightforward to adapt and change the content of these bilateral tax treaties. So what do we have from that? So through the OECD G20's inclusive framework, about 140 countries and jurisdictions are at various stages of implementing the actions to tackle tax avoidance, to improve the coherence of international tax rules, to have a more transparent tax environment, and although this one obviously has still got a lot of work to go, address the tax challenges arising from the digitisation of the economy. In terms of developing this, the Multilateral Convention to implement tax treaty-related measures to prevent base erosion and profit shifting, a huge mouthful. You can know that as MLI. That was that very last action. This was designed to encourage and allow governments to modify bilateral tax treaties in a synchronised and efficient manner to give the real true effect to the actions under the BEPS project. It was also designed to reduce the amount of resources needed to renegotiate each treaty on a bilateral basis. As in November 2016, over 100 jurisdictions had concluded negotiations covering 96 jurisdictions, and therefore this there were sufficient signatories, so this entered into force on the 1st of July 2018. So the overall goal is to allow participating jurisdictions to swiftly and efficiently adopt supplemental or substitute provisions without having to renegotiate the bilateral treaty on a one-by-one or separate basis. Okay, another way to have a look at this is to do timelines, and it's quite interesting when you look at the on the far left-hand side of the screen. We see that we're talking back in 2013. The OECD put its initial diagnostic report together, looking at some of the BEPS activities. Then some months later, it published its 15-point action plan, not the final detail, but what it was looking at doing. Then onwards to mid-2014, there were various drafts and public consultation. So consultation here involves the various members of OECD and the wider global forum. It also involves where there might be submissions from other interested groups as well. Then in September 2014, there were various interim reports on a number of action items provided, then further discussion drafts and consultations, and then the final report to the G20 in October 2015. So you can see that it takes a long time to work through it. And indeed, if we look at the top of the two timelines, that actually gives us a better picture to where we're at today. So we saw the project commence in 2013. There was initially some proposed solutions, but no consensus in 2015. The interim report in 2018. This is then leading to some more detail, and I'll talk more about this in a moment, for dealing with Action 1 on the digitisation of the economy. 2019, there was the initial two-pillar solution and a program of work. We saw some blueprints in 2020. We saw in June this year, the G7 finance ministers agree to some of the key parts. July, there was a statement about the 130 forum members agreeing, and then the G20 reiterating its support. We're now in October, November. So October last month was the finalised two-pillar solution. Then as we move on in the year, there will be more details come out about some of those components. I'm going to talk more about that in a moment. So the desire is that by 2023, countries will be implementing these two-pillar solutions. And in a way, that's not the end of the project, because there's going to be a review at some time tentatively scheduled for 2030. That's so far in the future, I guess we can only say at most it signals there will at some point be a review of what is happening and whether it's meeting its intended objectives. So, Action 1, which is obviously dealing with the digitisation of the economy, a little bit more detail, just to give you a flavour for how long it has taken to get to the point that we're at now. So during the BEPS 1.0, when there was the final report in October 2015, the issue about the tax challenges of the digital economy was largely left open and unresolved. Then in March 2018, where there was the interim report, followed early 2019 with a policy note in terms of some of the issues that came out of that report. It was then open to public consultation. That led to a program of work to try and get a consensus. Now, if you're not aware of it, one of the key things of the way that the OECD tries to work is not by majorities or anything, but trying to get a consensus across all members, or in this case, the wider global forum consensus. And that's no mean feat to try and get a consensus. It generally seems to mean that what you do get as a solution maybe is not as strong as what some members would like, because you need to be able to accommodate everybody in that. So there was the program of work, then there became the public consultation of what was called the unified approach under Pillar 1, then public consultation on this new global anti-base evasion proposal under Pillar 2. Then in January 2020, there was a statement that came out about what these two pillars would potentially look like. Later that year, there was reports on the blueprints for these two pillars. And in the last couple of months of 2020, there was another round of public consultation, because what was in Pillar 1 and Pillar 2 was quite different in many ways from what came out in the 2019 public consultation round. Then January this year, there was consultation meetings on the two pillars. By the middle of this year, there was the statement that this would be the approach, this two-pillar solution. That was then eventually finalised in terms of the high-level statement back in October 2021, of which 136 member jurisdictions agreed to it. There were just a handful that didn't agree, so they basically abstained. And of the 136, this effectively represents over 94% of global GDP. So that is a significant portion of the world's economy. Currently, the detailed implementation plan has been developed, so we are told to expect that should be coming out soon. In 2022, there'll be more detail on Pillar B, Mount B and Pillar 1. I'm going to talk more about these in a moment. Then during 2023 will be the implementation and a review in 2030. Some people have termed this Pillar 2 to be base erosion and activity shifting. That is, it's looking at changing the activity and which jurisdictions may be able to tax it, but it does clearly have a focus of reducing this thing that's known of as the race to the bottom, that is to lower as much as possible corporate and other tax rates. Pillar 1 has taken more of the headlines, but arguably on a global side perspective, Pillar 2 is likely to have more impact. So let's talk a little bit more about what each of these pillars involve. So Pillar 1, excuse me, this is basically trying to reallocate the taxing rights to give market jurisdictions, so not jurisdictions where there's your traditional source or residence or permanent establishment, but where there's the market that the multinational has, giving those jurisdictions the right to tax a share of the profits of the very large and profitable MMEs, regardless of physical presence. It's expected, this is according to the OECD, that taxing rights on more than US 125 billion of profits are likely to be reallocated. In terms of the scope to be within Pillar 1, the multinational group needs to have global turnover of over euros 20 billion and profitability over 10% of profits before tax to revenue. So you're looking at, I guess, what you call these excess profits. It's going to include the largest and most profitable ME groups. It's estimated by the OECD that somewhere around 100 to 110 only will be included in here. So it's not in terms of number a large amount, but obviously it's a significant amount in terms of their GDP or their sales. Some exclusions, extractives and regulated financial services industries are out. The nexus or relationship here, the new special purpose nexus for determining amount A is where an in-scope ME, so that's the one that meets this criteria above, derives revenue greater than euro 1 million or greater than euro 250,000 in smaller jurisdictions. That is where the jurisdiction has less than 40 billion euro GDP. So what this amount A is, it's a new taxing right that will allocate 25% of these excess profits to the market jurisdictions based on a formula, not the arm's length principle. That's why amount A is held to be quite, from some people, controversial, because the traditional approach to dealing transfer prices, allocations, is the arm's length principle. What this is going to do is to use a formula, and this is where those who are strong advocates of formula apportionment get excited, that we're starting to see potentially a little bit of a move away from a well-established principle. In terms of the quantum of reallocation, taxing rights on 25% of the profit greater than this 10% is to be reallocated to market jurisdictions where the customers and users are located. So when we're talking about market jurisdictions, we're focusing on the customers and end users. Now, a number of jurisdictions have proposed or have in place unilateral measures where they've tried to basically have some type of substitute for this. And there's going to be a multilateral convention developed under the BEPS 2.0, and that will require all jurisdictions to remove anything equivalent to a digital services tax or DST. And they will have to give a commitment not to introduce these taxes in the future. So for those countries that do have a DST, not only obviously they're going to have to commit to this, but what they're going to have to do and look at is, well, how are they going to be placed in terms of what their likely revenue is under Pillar 1 versus a DST that they might have in place. In terms of enhancing tax certainty, this is particularly in the area of dispute resolution. There will be an intention to have dispute prevention and dispute resolution mechanisms for amount A developed, and they will have related issues covered in both a mandatory and binding manner. So when you see words like that, you can understand some jurisdictions might start to get a little bit concerned as to what that means. So there's going to be an effective binding dispute resolution mechanism for developing countries, and for those countries eligible for deferral of the Action 14 peer reviews, that's Action 14 under BEPS 1.0, and have no or low levels of mutual agreement procedures. So there will be some recognition for some developing countries where this might be a challenge in terms of what is expected under the tax certainty provisions. There's also going to be an amount B, and this is going to be the application of the arm's length principle. That's the traditional principle to an in-country baseline marketing and distributions activities in terms of simplifying and streamlining it. And so this is going to look at these activities relating to marketing and distribution. The focus is going to be on the needs of low capacity countries, and the work on that is yet to be completed. So we don't actually know exactly what that's going to look like. In terms of the administration of the process, the intention is that tax compliance will be streamlined, including the filing obligations of MNEs, and also for MMEs that come within Pillar 1, so that we're talking about that 100, 110, they're going to be able to manage the process through a single entity. So it will be managed through one, and then the process of distributing the taxes that are calculated will need to happen. There's also yet work to be done on how we determine the revenue sourcing, the tax-based determination in each jurisdiction, what is market and distribution profit safe harbors, what degree of segmentation will be allowed, and how they're going to deal with making sure that this doesn't lead to any double taxation. All of these issues are yet to be finalised. So again, even at this point, hopefully you can see there's a lot of work still to be done. Looking at Pillar 2, what Pillar 2 seeks to do is to put a floor on tax competition. That is to basically reduce this idea of the race to the bottom. What it will do is introduce a global effective minimum corporate tax rate, or ETR, of 15%. In terms of how much is going to be affected here, the OECD estimates about US 150 billion in additional tax revenues globally per year expected to be raised. What we don't know, obviously, is where and which jurisdictions that will apply. Within Pillar 2, we're going to see a whole lot new of rules. One is the globe, which we talked about earlier, this new global base erosion one, the income inclusion rule, or IIR, the undertax payment rule, UTPR, and treaty-based subject to tax rule, STTR. All of these concepts require further refinement. I will talk a little bit more about some of those in a moment. In terms of these globe rules, their intention is to have a common approach across all the jurisdictions that have agreed to implement this BEPS 2.0. However, and this is rather interesting, jurisdictions are not required to adopt these rules, but if they do choose to adopt, they must implement them consistently across all countries that they've got interactions with their multinationals. Secondly, they have to accept the application of these rules if they're applied by other member jurisdictions. This includes rule, order, and safe harbor. So if there's another jurisdiction that you're involved with in terms of some type of treaty relationship, and they're going to apply their rules, then you have to accept those rules will apply. Again, this is going to add quite a lot of complexity. The scope to be in here is the Euro 750 million threshold, which some of you might recall is the threshold that's used for country by country reporting under BEPS 1.0. So there's a consistency there. However, countries can implement the income inclusion rule below this threshold on any multinational that's headquartered in their country. So they can choose to impose it on a lower than Euro 750 million revenue threshold. There's a lot of entities here that are out of scope. So all government entities, international organizations, it's a little bit unclear exactly the scope of that, non-profit organizations, pension funds, and investment funds. And in terms of income that's excluded, international shipping income is excluded. So in terms of how the effective tax rate is calculated, it's essentially like a top-up tax. So in essence, if the effective tax rate is lower than the 15% rate that's been set, then there will be the ability to collect, or tax will have to be paid between what is being paid and the 15%. This ETR is going to be calculated on a jurisdiction by jurisdiction basis. It's to use a common definition of covered taxes, so that has to be agreed to, and a tax base determined by reference, and this is interesting again for the accountants, reference to accounting income. So we're going to obviously make a lot of use here of how income is determined for accounting purposes, including obviously international financial reporting standards, etc. There will be some agreed adjustments. Again, more detail is needed on exactly what they will be. The minimum rate, not only for the standard ETR, but for the IIR and UTPR is also 15%. However, shouldn't be entirely surprised, there's going to be some carve-outs and some de minimis exclusions. So there's going to be a formulaic substance-based carve-out to exclude the amount of income that is 5% of the carrying value of tangible assets and payroll, and this will have a 10-year transitional period. There will also be a de minimis exclusion. So if a MME has revenues less than 10 million euros and profits less than 1 million euros in a jurisdiction, then that jurisdiction falls out. So we don't need to look at to apply ETR calculations there. Now, the US has had its own rule in place, the known as the GILTI, and what they have yet to work out is under what conditions will the GILTI regime be able to coexist with the globe rules to ensure a level playing field. So again, this adds another degree of delicate diplomacy as to how will the US, which has, I guess, until the current administration came in, was very much not wanting to advance the BEPS actions, but there's now been quite a change under the current administration. But again, there's going to have to be how are these two regimes going to work together to ensure a level playing field. And in terms of simplification, there will be efforts made to ensure targeting and avoid disproportionate administrative and compliance costs. There will be a number of safe harbors and other mechanisms, details of which are yet to be finalised. Okay, the other new part of Pillar 2 is the subject to tax rule, and the proposal here is that there will be a minimum rate set of 9%. So where there is a nominal corporate income tax rate below this minimum rate on items of interest, royalties, and other sets of payments, and there's definitions of what they are, then this STTR will have to be implemented via the bilateral treaty and doing this particularly with developing member countries when requested to do so. So one of the critical things here is to be able to find out what are the rates that are applied to things such as interest, royalties, and other payments. In terms of what is a developing member country, this is defined in the purposes of this proposal to be those with a GNI per capita calculated using the World Bank Atlas method of US $12,535 or less in 2019, but they propose they will update this figure regularly. So the key thing of the subject to tax rule is that the difference between the minimum rate of 9% and the actual tax rate applied on the payment will be the taxing right that a jurisdiction has to ensure that these types of income are taxed at no less in effect than the 9% rate. Okay, so how are we going to go about, well, this is how the OECD and Global Forum proposes to implement, first of all, Pillar 1 and then implement Pillar 2. So in terms of the amount A, this is to be implemented via a multilateral convention, very similar in concept to the multilateral instrument under BEPS 1, with domestic ratification in each jurisdiction and law changes with the intention that all of this comes into effect in 2023. So the multilateral convention is designed to facilitate consistent implementation for all jurisdictions, even if there is no tax treaty between various members. And they're also going to develop an explanatory statement. This is something that the OECD often does to give, I guess, more detail of what's intended behind various instruments. So the MLC will have rules to determine and allocate amount A, eliminate double taxation, simplified administration processes, exchange of information processes for dispute prevention resolution, and to address interactions with existing and future bilateral tax treaties. So you can see a lot of work there. There is, within this whole process, a task force on the digital economy, the TFDE. It is working to clarify and define the features of amount A, that is particularly how to eliminate double tax and how to have marketing and distribution profit safe harbors and work on the content. It is intended to conclude the text in early 2022, so not too far away, with the intention that this multilateral convention will be available for those willing to sign for a special ceremony for mid-2022. So again, a similar type idea to the multilateral instrument under BEPS 1.0. In terms of the digital services taxes, the MLC will require their removal and a commitment not to introduce them or anything similar. And there's going to be a detailed definition to be developed in the MLC and ES exactly what it means by these types of taxes. In terms of the domestic law changes, the TFDE is intending to develop model rules and commentary that each jurisdiction can then take, consider, and if it so determines, ratify. It's important to recognise that even a high-level agreement at the governmental level doesn't mean a jurisdiction is actually going to make the changes. It needs to ensure that it goes through its domestic law process, whatever that is, to review and pass the necessary legislation to make the thing to be effective. In terms of the amount B, Working Party 6 and the Forum on Tax Administration's MAP Forum is working on this with the idea that it will have determined amount B by the end of 2022. In terms of Pillar 2, the Globe rules, along with the commentary, are to be developed by the end of November 2021. So today's the 30th, so if they're on target, we should be virtually there. In terms of the scope and mechanics of the IIR and UPTR and how to determine the ETR, etc., all of those things are going to be developed and should be available soon to see. The model treaty provision for the STTR is to be developed by the end of November again this year. A multilateral instrument to deal with the implementation of the STTR for relevant treaties is due to be developed by mid-2022. And an implementation framework for implementing the Globe rules is intended to be developed by the end of 2022. Now, I've talked about a lot here, but if you are keen and want to have a look more, there's a website link there to the OECD's website on Action 1. Okay, I briefly want to just again sort of draw some of these large amount of words and things together in a graphical format. And if you look at the first one here, this is from the OECD's website, you'll see Pillar 1, which is notionally called the unified approach. You can see that the key things are amount A and B, and then obviously how they're going to create certainty and implementation. Relatively speaking, if you look at that, amount A has got so many components to it that it is clearly a very complex concept. So it's its scope, nexus, the tax base, allocation, and how to eliminate double taxation. And just looking at those things that need to be developed, that gives some appreciation of why it's taking so long to make headway. Okay, if we look at Pillar 2, which is highlighted by the Globe proposal, again, you can see that there is quite a number of things that have been worked on. So there's the income inclusion rule and undertax payment rule that we talked about. There's quite a few components there, the thresholds, the tax base, the covered taxes, blending together, how to deal with timing differences, scope and carve out, but also simplification, design and allocation. Then there's when we have a switch over rule between the different components of Pillar 2, how the subject to tax rule works and how all of these rules coordinate, what order they work in, etc. Again, just looking at this at the high level, the complexity is significant. So that's talking about this generally. How has all of this affected Hong Kong? So going back a little bit to about 2013, Hong Kong had a largely compliant report from what was known then as the Global Forum on Transparency and Exchange of Information when a peer review was conducted, but some areas for improvement. So eventually, after a lot of debate, legislation was enacted to enable tax information exchange agreements. So those are agreements for exchange of information between what some might call countries that are low tax countries. It then negotiated with the US in 2014 an intergovernmental agreement on the Foreign Account Tax Compliance Act, or FATCA. Through the People's Republic of China, it became a signatory to the Multilateral Convention on Mutual Administrative Assistance in Tax Matters. So this is pre the BEPS information, but this was a convention to help in the administration of cross-border issues. It came into effect on the 1st of February 2016. There was an amendment to the Inland Revenue Ordinance in 2016 to allow for automatic exchange of information. Then in terms of BEPS 1, Hong Kong accepted an invitation known as Hong Kong China in June 2016 to be an associate to the BEPS initiatives. Even being an associate required Hong Kong to facilitate the actions as were relevant to it and to work globally with other members. Later in 2016, consultation on BEPS commenced with a proposal to introduce draft legislation for the first half of 2017. In 2017, Hong Kong made a priority that it would meet the 4 agreed BEPS minimum standards, that is the standards under Actions 5, 6, 13 and 14. It implemented the multilateral instrument to give effect to these in February 2018 via an amendment, but having said that, there is no ratification instrument deposited with the OECD. It launched country-by-country reporting via a portal in March 2018, with the first exchange occurring under the Common Reporting Standard later that year. It amended its transfer pricing legislation in July 2018, again amending the Inland Revenue Ordinance. So all of that relates to pre and also to BEPS 1.0. In terms of BEPS 2.0, in June 2020, an advisory panel was set up to assess the impact and make recommendations to the government. And at that point, Hong Kong announced that it was fully committed to implementing BEPS 2.0. It made this statement in February 2021, but it will do it in a way to ensure that the advantages of Hong Kong's tax regime are maintained. That is, to maintain the simplicity, certainty and fairness of the regime, to minimise the compliance burden for affected enterprises, and continue to improve the business environment and competitiveness. So this raises, again, a number of questions of all of this BEPS action, particularly BEPS 0.2. What are the implications? So the first thing is, should Hong Kong agree to facilitate the implementation of BEPS? If it does, then this will facilitate, in a general sense, avoiding a proliferation of unilateral tax measures by some countries, such as the DSTs. It will reduce, if not eliminate, harmful tax competition and preserve incentives for real economic activity. More tax will be paid in more countries with a fairer allocation of taxing rights, including countries where consumers and the underlying economic activity resides, and conceptually at least, and again we take how we interpret this, a fair share of tax will be paid by multinationals. So by implementing BEPS, Hong Kong is signalling it agrees with these points. What is the impact though? Well, very, very few Hong Kong businesses will be directly impacted, and none of the SMEs. Currently, the statutory corporate tax rate is 16.5%. It exceeds the minimum rate, but there is some concern that if the rate is less than 15% effectively, then the IIR may operate. So it's important to say you can have a statutory rate, but you still need to check when we see the details of the rules, is the effective rate 15%? So Hong Kong will also have to look at all its bilateral treaties to ensure the minimum STTR, that's the 9%, on things such as dividends, interest and royalties has been met. And if it's not, then there will be this additional taxing right that comes in. So what is the approach to date overall for Hong Kong? Well, it will continue with its territorial source principle, but it may need to make some changes because there has been clear statements that it wants to make sure it comes off the EU's grey list of jurisdictions with respect to some of the source rules. It's set up this advisory panel, and the advisory panel, which is chaired by the Secretary of Financial Services and the Treasury, with a wide range of members, has a very clear term of reference with respect to looking at BEPS 2.0. That is, to review the possible impact of the latest requirements on the competitiveness of Hong Kong's business environment, and to advise the Financial Secretary on strategies and measures to facilitate the sustainable development of Hong Kong as an international financial, trading and business centre in light of the changing international tax landscape. However, we're not going to know about the outcome in the sense that the report won't occur until the BEPS 2.0 details are finalised. Now, potentially this could be, for some of them, December this year, but others aren't going to be finalised until 2022. So it's unclear as to when it will be in a position to report. It's expected generally, this is at least my view, that BEPS 2.0 will be implemented according to international consensus, but Hong Kong will need to be convinced that it can maintain its competitiveness, keep compliance burdens low, and improve the overall business environment in doing so. And again, if we look back and reflect on history, Hong Kong has quite often been slow to make changes. It's been very reflective on making those changes, but sometimes has clearly felt international pressure. Whereas in this case, it seems as though Hong Kong is a more willing participant to be part of it, but needs to think about the situation and how it affects it when the full details of BEPS 2.0 are actually known. So what can we take from this? So clearly Hong Kong has supported BEPS 1.0. It's signed the multilateral instrument, which would adjust and bring in the changes to the various bilateral tax treaties, but there's no instrument of ratification being deposited, and neither is the same for the mainland. And so this raises a question to think about: is there a lack of real commitment? Is the commitment more than doing the minimum required? Secondly, we haven't seen, and it could be some time before we see the recommendations of the advisory panel on BEPS 2.0. My sort of surmising is it would be unlikely to recommend changes to Hong Kong's tax regime unless BEPS 2.0 supports Hong Kong's ideals or it's facing undue international pressure to conform. Some changes to passive income under the STTR rule are expected, and that's going to depend upon reviewing all of the bilateral tax treaties. There may need to be some review of the profits regime if effective tax rates are found to be less than 15%. So it's not just the statutory rate that's important, but it's the effective tax rate. It may also need to review some areas of exempt income, depending on whether they are permitted to remain as carve-outs or not under the BEPS 2.0. Some multinationals that operate in Hong Kong are bound to, if BEPS 2.0 goes through, to experience heavier tax burdens, will have extra compliance costs, and potentially there may be more tax disputes. That, to me, seems unlikely, regardless of the rhetoric of saying wanting to minimise it. The obligations here are likely to do this for a number of MMEs, particularly for those under Pillar 1, where those ones are going to have a lot of work to do. It's likely that this could affect Hong Kong's popularity as a global financial hub, and that's going to be a crucial issue in making decisions. But in many ways, ultimately, any effective change will depend largely on the approach that the mainland takes, such as with respect to ratification and deposit of relevant instruments. And that point covers my presentation. So I'm about to stop my slide sharing and open up to questions and comments. And over to you, Richard.
Well, thank you very much for the presentation. I mean, a very complex set of matters. I must say, lucidly presented, although I'm glad there's not an exam at the end of this presentation.
I agree.
I have to go away and put my head in a book for about 3 days to get, to come to grips. But it's great that you've been able to set things out in this way. I should mention, I'll confirm with you now while you're online, but we've got a copy of your PowerPoint slides, which really are quite detailed and will repay careful reading for a number of people. And I believe we're going to make those available to participate.
Yeah, that's fine. I've noticed a couple of very minor typos. So if you indulge me to correct those, and I'll send another copy after today, you're welcome to have them available.
Okay, sure, because I think we've had a question about that. I've got a few questions, I must say, that have been prompted by the presentation. But I see we've got at least one substantive question, which is designed to get you thinking. perhaps you could have a look on the question box and see what your response might be.
Okay, I'm just having a read of that now.
Yeah, take your time. We should have a bit of music to play while you're doing this.
Okay, yep. So looking at that comment, it's not an uncommon perspective in terms of particularly developing countries or countries that want to or believe that they want to have a tax system that might be different to what the OECD desires, that they feel that the OECD's approach does put pressure. And I totally agree that this is one way to look at what is happening. That pressure is put on because I guess a lot of the particularly OECD member countries, some of the wealthier countries, those that have got large markets, they feel that they are often missing out on their share of the revenue where multinationals are putting the revenue into other jurisdictions. And I do have sympathy of the feeling that once you are signed up to this, you have given yourself a commitment to the principles. Where the real difficulty comes in is once we start to see the details. And it can have a real effect. So if you're on a blacklist like the EU or the OECD is saying you've got some problems, it's a very real issue about how does that affect the perception of people externally who want to invest there. They might be a bit reluctant to do so. So I do feel that certain jurisdictions do come under more pressure than others.
Okay, I see there's a couple of other questions. One asks, what is the questions? Those who are looking online apparently can't see it. My technical ability to explain that is, well, I just don't have it. So perhaps as you answer these questions, you might either read out the question or say content, if that's okay.
Yeah. So the one that I spoke about was more about the issue about that only the large multinationals, that smaller ones, I agree, can also be affected, talking about the way the OECD uses threats and blackmail techniques, etc., the issue about the being on the grey list, etc. And so some of the sentiment of that I fully understand, and I guess coming from a country that generally supports the OECD but also is a very small country, on some occasions we've not always been too happy either. And then you've got the opposite side where you've got the US that is a very powerful country and often can say, well, look, we're not going to do what the OECD does.
Okay, I think there's one number 4 question there you might like to have a look at.
Okay, so it's saying, is Hong Kong considering implementing new rules like alternative minimum tax regimes? Well, if it is, I'm not aware of anything made public. I can only rely upon what I can find on the public sources. Having said that, if the final BEPS 2.0 goes through and Hong Kong implements that domestically, then there will be some effective minimum taxes that have to apply. So there'll be the effective minimum 15% effective tax rate on the normal corporate profits. There will also be the STTR 19% on other items. So there will be some effective minimum tax regimes brought about, not necessarily because it's what Hong Kong wants to do, but that's what the requirements are under BEPS 2.0 if the recommendation of this action group to the government actually says, yes, you should do it. But I'm not aware of anything else at this point, at least it's not been made public.
Okay, well, it looks like we've got I'm sure more questions may come, but there's now space for me to ask a question or two. Maybe I can roll two together. You've talked about the influence of the US or concerns that have been shaped by the US experience within tax and international tax, and also the signing up to these agreements and then ratification. So I'm just wondering about if you could illuminate and also make a comment or two possibly. In your estimation, I mean, just based on your significant reading in this area, how much would you say this whole BEPS operation is very strongly shaped by the US approach to international taxation? Or is it really moving quite a way away from the US approach, which sometimes I can say from a little bit of personal experience, I know has involved, when push comes to shove, beggar thy neighbour. Providing the US gets to collect its tax, is not too worried, historically I should say, not too worried about what happens in smaller jurisdictions, including Australia.
No, that's a massive question, and I would say that the link and the role of the US has changed over time. A lot of it, I think, linked to the administration at the time. So, for example, when the US brought in FATCA, which basically was bullying every country in the world to say, if you don't enter this agreement to provide this information, then we're basically going to require a tax on the total value of accounts, which obviously would include capital, not just income. So it virtually forced most countries in the world to enter into it. And it was purely US focused. But having said that, the OECD and others then started thinking, well, this whole idea of exchanging information, collecting taxes doesn't seem like such a bad idea. So we started seeing exchange of information and other things growing after that. So it's almost like that was a push to get that going. Then we see under the most of BEPS 2.0, although not since the Biden administration came in, but when the Trump administration was there was a complete, we're not interested, we're not doing anything, we're doing our own thing, we're only interested in what the US will collect, and very worried about the fact that a lot of what BEPS 2.0 was going after many multinationals that were headquartered in the US. And so they're actually thinking they could lose revenue potentially as a result. So the US, there was quite a disjoint. And now we've seen under the Biden administration a much more closer working together between OECD, US, etc. So it seems to ebb and flow. The US is probably one of the few countries, and the EU as a group of nations that probably can push things more than anyone else.
Okay, look, there is another question come up, but just let me do my follow-up question at this stage, which relates to what you said earlier and have just said now. The picture that you give is that as you engage as a jurisdiction with BEPS 1 and BEPS 2, you become committed. And you're meant to stay committed, and you agree to do certain things, and you clearly give up a degree of tax sovereignty and so on, but for the public good, but also for some jurisdictions for personal good, local good, all of that stuff. I understand. Given the response of the US prior to the current administration, and given to the way that the previous administration, the Trump administration, walked away from agreements on Iran and also climate change, from your understanding, if there's a change back to a more, what can I say, for want of a better term, less international anyhow, US administration in 2024, can the US just walk away from BEPS 1 and BEPS 2 again?
My surmising, and I would have to look in what the detail is, that these are consensus agreements which you in principle agree that you would then ratify. The way the OECD and the Global Forum works, it's not like you're thrown out or you can't choose to move away. So I can't see why a jurisdiction can't move away, but there would obviously be a lot of pressure applied to try and stop that happening. Now, if you're a very small jurisdiction, that may not be such an issue. But again, with assuming BEPS 2.0 goes through and the US moves away from it, that's going to cause a massive impact, because a lot of the big multinationals affected are in the US. The rules have been developed for the US is guilty and the globe to try and work together. So in a case like that, I don't think we have much precedent for that in terms of our new globalized working together world. But it would be fascinating in a slightly scary way if that does happen.
Okay, well, we'll see. When you mention multinationals mostly being US and their links, their ability to talk to government, let's put it that way,
yes,
very directly and explain their position very forcefully. As you say, it seems to me it leaves open a problem that may emerge or may not, but we'll have to wait and see. But I see we've got some more questions which have arisen, at least one more anyhow, that's right. So perhaps you'd like to have a look at that from Joshua Lai.
Yep, so it says, in view of the global minimum agreed tax rate of 15%, does the two-pillar solution prohibit non-tax incentives for low tax jurisdiction countries to continue to attract foreign direct investments? The most that I can say is that's probably an issue that's going to have to be worked through in the detail, because BEPS is primarily about tax, but quite clearly you can choose to use non-tax things that give a similar outcome. And so I suspect this will be an issue that will have to be worked through as part of the details. And it's one of these cases, the devil's in the details. We're yet to see all of that. I suspect this will be an issue amongst many others that will have to be looked at. And if they're not looked at, then obviously that would create a potential gap to be able to get around some of the effect of this minimum tax.
Okay, well, I think I've, as I say, I had quite a few questions. I may have space to ask a further one, which relates to something which you said, which is Hong Kong relevant. You mentioned Hong Kong's role as a global or international financial centre and how the move away from the status quo, let's put it that way, to a more BEPS friendly, compliant, whatever the right term is, arrangement could undermine that position to some degree. So my question is, though, I mean, where would the alternatives be if it's, if there's so much pressure for Hong Kong to adapt to this new international environment and accept these rules into Hong Kong? My surmise, perhaps wrong, is that the leading competitive jurisdictions will all be forced to do the same as Hong Kong, whether it's Liechtenstein or Switzerland or Singapore, or indeed the US. It's pretty good at carving up systems to make, the operations tax friendly. So I wonder if you would like to comment on that.
No, I think that's a good point. And some of it will depend upon, when we see the detail, to the extent to which there is, and that's applied even under BEPS point 1, jurisdictions could choose, for example, when they adjusted their treaties, to what extent they wanted to make adjustments. So there was permissible variance. So we could see, for example, where there is a degree of variance, certain jurisdictions choosing one over another. So that's one approach. I guess a lot will depend, because Hong Kong's a wee bit different because of what concern, if it's growing or not, about the influence of the mainland as well. So it's not just assuming status quo there, but also whether that might change. But you're quite right. People are going to have to put their money somewhere. If most of the others do similar things, the question is, well, am I going to get an advantage going anywhere else? Or worst case scenario, which may be not what's wanted here, is that people will look to go to jurisdictions that are not part of BEPS 2.0 and decide whether they want to take on what the associated risks are there.
Yes. Okay. Well, very good. Thank you. Good points made. I would just add, of course, that the relationship with the mainland is very much works in many directions, including Hong Kong's economic performance has been intimately connected to the mainland for well over 150 years, and that linkage is improving. I've just done some recent figures looking at the development of the mainland economy, and even if things are fairly, slow down to some degree, it looks like it's going to continue moving along at a good clip. And in overall terms, as somebody once said, a 3% lift in the performance of a 15 trillion economy is much more important than a 10% lift in a 1 trillion economy. So we'll have to see how that, what the opportunity, I suppose, is to go elsewhere if you want to be involved in that. But I think we now have another question, which is good, is it? Yeah, let me look.
Yep.
Yes, there you go. I'll leave it to you.
Okay, so what specific consequences or pressure are there for countries that have not signed up to BEPS 2.0? Well, from one perspective, the inclusive framework or global forum was all about inviting jurisdictions, so there was no direct pressure to join. I guess the issue is if you don't join, what might be the pressure? It's a bit like you've got a voluntary club to join, but if you don't join, what pressures do you get by choosing not to join? And for some countries, if the US stayed out of it, they could easily weather that. But for a smaller jurisdiction, that could actually have major consequences, particularly, say, although it's not applied here, if you go on a blacklist of some sort. Many, many years ago, the OECD did create a blacklist of jurisdictions, and that's when the tax information exchange agreement process came in to allow what we traditionally know as tax havens to be able to get off that list by entering a certain number of those agreements. So in some cases, the pressure could be a blacklist, or it can certainly be applied in other ways. But because it's not a you have to join, in one sense, the pressure is not a compulsive one. And if you think about 140 jurisdictions, I'm not sure how many jurisdictions there are in the world, but I think that there's probably around 200 or a bit more. So there are quite a few, but it does cover 94% of GDP. So from that perspective, the vast majority of the economy of the world is actually participating.
Okay, very good. I see another question has come up from Belinda Law. You might like to look at that, Adrian.
Okay. Implementation of BEPS 2.0 in Hong Kong is likely going to be through legislative changes to Inland Revenue Ordinance. However, do you think there will be a change to the legal test of source of profits in common law jurisdictions which impose tax on a source basis, e.g. Hong Kong and Singapore, in the near future? I have two levels of answering that. One is you can think conceptually based on these general principles that we have now. So if what you use as a test of source of profits doesn't align with the general principle that is being put out in the draft of the BEPS 2.0, then potentially yes. But what we really need to do is wait till we see the detail of exactly how some of these bits are to be put together, because the task force is supposed to help develop guidance for countries that are going to make sure they're going to be compliant with all the different parts of determining Pillar 1 and Pillar 2. So my answer is I can't be as precise as I'd like to be, because the devil's going to be in the detail to see exactly what's expected on this. But potentially, at least, if your concept of source of profits doesn't seem to align with what's going to be expected under those principles, then you may need to make further change.
Okay, well, thank you. Let me, got a couple more questions, different ones, but let me ask this one. Again, really trying to dig into your, the foundations of your wide understanding here. And I'm wondering what impact, if any, you could see from being fully signed up to BEPS 1 and 2, ratified the whole shooting match, as they say. What would happen if a jurisdiction then tried, to go ahead with a major tax reform in an apparently not related area, but would they need to think about the impact, the BEPS compliance impact? So to give a concrete example, as you know, there was discussion at one stage about introducing a GST in Hong Kong. So that would be one example. I mean, in my view, it will come eventually, perhaps not while I'm still sitting here doing this sort of stuff. But another possibility, and this is even more remote, I know, but I mean, the place that really badly needs a GST most of all, it seems to me, is the US. And of course, the problems of implementing it there. I mean, they still can't get past using the imperial system for most measurements, and efforts to get past that, from my reading, have all just fallen apart in the US because of pushback from various people who want to think in inches and feet and the rest of it. So I'm just wondering, generally, what do you think, being fully signed up to BEPS 1 and 2, in a more general way, how might it impact tax policy reform?
I guess one way to divide it is, broadly speaking, BEPS is looking at measures of income and taxes on income, broadly defined. Whereas if we're looking at, say, a consumption tax, for example, of a GST, one would say that's a GST is unlikely to be something that is going to have an impact on what's happening with the BEPS thing. So, but if we looked at saying you want to make a change, and one of the clear changes is you don't like the way that Pillar 1 and Pillar 2 are working in your jurisdiction, and you had or you were proposing something akin to a digital services tax, you might say, okay, well, we want to bring that in because we actually think we would do better. That would be an issue of, well, now you've acted against an agreement that you have signed up to. What are the consequences? And that's something I think yet to be resolved if you were to go and do that. But in another sense, if your tax policy approach isn't aligning with what BEPS 2.0 is doing on your cross-border side of things, then you're probably going to have to rethink that if you want to continue to apply the spirit and the principles that are behind it.
Very good. Well, I think we've got yet another question there, so perhaps you could have a look at that, Adrian.
Okay. Hong Kong government keeps saying that Hong Kong will look into non-tax ways to improve competitiveness now that all economies that have signed on to BEPS 2 are on a level playing field, as well as ways to reduce compliance costs for multinationals. What specific are these that Hong Kong can still do? It relates a best to one of my earlier comments, is that while BEPS is primarily targeting tax, I'm sure as part of the detail process as we see it emerge, they're going to look at, well, can you achieve the same thing through another way, which might be a non-tax way? And so they might look at and say, to what extent will those fall foul of what you can do? Versus, well, what is the OECD and the G20 and the prerogative here? Does it actually extend beyond tax to other areas? So I guess this might come down to, first of all, when we see the detail, what is captured, what is excluded, what can still be done. And if it doesn't look at dealing with non-tax ways, then potentially that suggests that's an avenue that's going to be open.
Okay, well, I think let me see how we are with the questions. I think we've covered all of them now and had a good selection. And as you can see, you've got me thinking. I won't lose sleep over it tonight.
I hope not.
But it's very, very important, and it's great to have it set out this way. And thanks for taking all of the trouble with the slides as well, because I know they'll provide a good framework for people who want to, indeed need to, think about this in a more thorough way. Just before we finish up, I would make the observation, a little bit facetious, but not entirely so, I think. It's probably fortunate that as all of this is gathering speed, that such remarkable headway is being made in the development of artificial intelligence. Because I can see, looking at your graphs and so on, the kind of algorithms that you need to have going on up here in order to get through. It looks like it's going to be quite helpful to be able to press a button and let some tax AI work its way through and tell you what certain options are in a fairly conclusive way. But I must say that also worries me, given that whatever the technology is, multinational enterprises and their excellent tax advisors often are, at the head of the field when it comes to applying these sorts of devices. Now, it seems to me, this is putting it too simply, I know, but the purpose of BEPS is to collect more tax and distribute it more equitably, especially from these multinational, transnational, large-scale operators from wherever they happen to be based. And so, a good intention, but we're going to have to see how that goes and how it works out. Artificial intelligence, I don't know, but I think we'll have to keep an eye on that as well. Maybe you've thought about this yourself.
Well, I know that many professional firms and others are already using it extensively, which is taking away some of that old hard legwork that the recent graduate had to do when they came in. But at the end of the day, even if you've got it churning through and doing everything, you need your quality control check that the data going in and the way it's working. And somebody's got to look at what comes out at the end to be satisfied, because the multinationals are going to have to sign off on their returns with this information, and it's going to be open to multiple auditing, potentially across a lot of jurisdictions.
Very good point. Well, look, I think on that note we'll end, Adrian, unless there's any final comment you'd like to make.
I don't know. Looks like there's one more comment or question
please.
that's just come up.
Okay.
Saying, how can the City of London be cut out of compliance? And it's got level playing field. Not 100% sure. I guess it's maybe looking at the role that London has with the multinationals that are operating in Hong Kong. So I guess in one perspective, what this is trying to do is take away from looking at on a jurisdiction by jurisdiction basis, but looking at multinationals as a global perspective, which is what potentially, if you're looking at a formula apportionment, does it. It spreads an entity across everywhere that it operates, rather than look at one jurisdiction by one jurisdiction. So what this is maybe doing is saying we're going to have to be looking at what they do across the world where they operate, not just between one jurisdiction and another. I'm not sure whether I'm interpreting that question correctly or not.
That sounds about right, but and a useful comment. Is there any more, I wonder? Is there another one that's come up?
Oh, yes. From the same one, it's got current announcement with OECD. Okay, so there must be something new there that I would need to have a look at.
Okay, well, that sounds like we'll need to get you back, Adrian.
Maybe in a year or so, 18 months, when we know some more detail and see what's happening.
Well, that's good. Well, I think we had better finish it up there. But seriously, we look forward to having you back in Hong Kong again. You're a most welcome guest and have made some terrific contributions on your visits here. I'm not sure how many now, but it's I think maybe more than the fingers on my hand, which is great. And thank you for doing the work. And we look forward to getting the slides once you've done your tidy up. I always find that one, as soon as I use the PowerPoints,
that's right. It changes between the screen and what's in the file.
It's amazing, isn't it? But there you go. My typing is appalling, of course, so that's probably part of it.
Yeah. Well, again, I thank you for the opportunity of being able to be as close as I can in these times in terms of being present and presenting. So I do hope maybe the next time I can be in person, but we'll just have to wait and see.
Okay, well, thank you again. And thank you, everybody, for joining us this evening, and also for the very good questions. It's been a really stimulating discussion. Thank you. I think, and we'll finish up now. Thank you again.
Okay, thank you.